All right, team, let's get pre-market prep started. Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
Hello, traders and investors. Let me get the chart up here for you right now. We are looking at the June contract, folks. March will be going off the board on Friday. That's what we need. We need a little bit more volatility with the quad witch coming up. So ESM23, depending on your platform, at ES and many platforms. But I'm going to be talking the June contract now, and it's basically flat at that closing price, just a couple ticks above or at 97.50. Believe it or not, the overnight range is just about the same range that we had on Friday during the intraday session. So we'll see. Right now, much closer to the low than the high. We have the buck down 32 cents at 103.82. The bonds up again. What a move in the bond market. Up just over 2 points at 131.12. Crude taking a hit now, down 292 at 73.78. Flight to quality with gold up 25.80 at 18.93. Silver back in the 21 handle, up 67 cents at 21.17. And Bitcoin up $2,145 at 22,100. So we got a lot to cover today. Obviously, we are in a very unusual situation here with our banking system. Let's bring in Triple D and Money Mitch and Dennis. Been around this rodeo before here.
Yeah.
What's different?
Yeah, no, it feels like the financial crisis, like from a trading perspective in the banks, it feels like a financial crisis. And I think it is going to be a financial crisis for some of these regional banks here. I mean, what has transpired over the weekend is nothing short of incredible. And there is an exodus happening here right now, which we were talking about even on Twitter last night. And I kind of felt the same thing. I'm like, investors are going to flee the regional banks after this move. So, Mitch, let's catch the audience up what exactly has happened last night and over the weekend here, because a lot of news, a lot of important market moving news has transpired.
All right, let's get into that. SVB was closed by California's Department of Financial Protection after it struggled to raise additional capitals and concerns of cash burn and liquidity. The FDIC took control of the bank via a new entity called the Deposit Insurance National Bank of Santa Clara. And then Sunday, also regulators also shuttered Signature Bank in New York, which had been popular amongst cryptocurrency companies similar to SVB. On Sunday evening, they also backstopped all depositors in the failed Silicon Valley Bank and Signature Bank. And now this morning, of course, we're seeing multiple banks down big. The Federal Reserve did also say it's creating a new bank term funding program aimed at safeguarding institutions affected by the market's instability of SVB's failure.
And obviously, it's the big thing here is the Signature Bank here. So SBNY, This is the news that kind of came a little out of the blue, not completely out of the blue. We knew SBNY had troubles, but to come in and basically FDIC moving in and seizing the assets. Can you just go into a little more detail there, Mitch, on SBNY?
Yeah, so pretty much they stepped in there. Depositors were getting concerned about that. So the FDIC just stepped in and took the bank there. And I think the really concern is that these had cryptocurrency exposures, right? And then I think that also might have played into it here with different exposures into cryptocurrencies. That also shot cryptocurrency higher. I don't know if you guys noticed that one, but definitely you're seeing
moving on it,
yeah, and different action actually happened there with the USDC coin. I don't know if you guys caught that, but with Circle, it was said that 3.3 billion was now held from SVP, was fully available on Monday when US banks opened. So it looks like that's an actually cryptocurrency flying higher. Now, is that just a spike and then it could easily come right back down? I think that could definitely happen there. There's a lot of concerns also where the exposures of these banks lie. I know that you guys saw the biotechs. You guys were talking about it on closing print on Friday that the biotechs were getting destroyed. Will this continue to come in on different companies? We saw Schwab get hit. Where's the exposures?
I think we
that's our
just don't
question that we
know.
need to
I think
ask.
I think the biggest question is we just don't know.
Yeah.
There's so many unknowns here. And the one thing that I feel like, my initial thoughts here, especially with the whole SBNY, let's ignore let's ignore the SIVB for a minute here and just talk SBNY, because this is my concern. And again, SBNY was in trouble, but my concern as an investor, I get why they did it. And maybe they had no other choice because they don't want the fallout. They want to show that we're coming in, especially with, SIVB. I get why the government has stepped in here. I understand it, to protect the depositors, to protect people, to make them more comfortable that your money is safe and the U.S. government's got your back. The FDIC's got your back. The problem is that was at the expense of the shareholders and the bondholders. So what you're seeing happen this morning, which is somewhat predictable, is that everybody who owns a regional bank is like, get me out now. And if you look at the KRE here this morning, it is down 7% more. If you look at FRC here this morning, which nothing has been done on FRC yet, it is down another 65%. You want to look at Comerica, CMA, huge bank, down 20% here this morning. We have basically regional banks collapsing multiples now because investors are scared that, hey, FDIC might just come in tomorrow, seize the bank, and I'm out. I have no money, if I'm invested in there. So you're seeing capital fleeing these stocks. Now, maybe this stops the bank runs, but it is causing capital to flee out of this sector. And I don't know what turns that around, because on SBNY, you literally just buried the shareholders and the bondholders to protect the depositors. And I get it. I get why they did it. But this is what is the result. This is going to be that capital is going to flee the regional banks, and it's starting to flee the majors here too. I mean, Citigroup is having a rough day. Bank of
All
America,
of them are JP Morgan, even JP
yeah,
Morgan,
when you
Bank of
bury shareholders like that just out of the blue, the government comes in and just buries shareholders out of, not completely out of the blue, like you knew there was a little bit of trouble there, but to come in and just seize the assets, because obviously fear of a bank run is a difficult thing to do. This bank was not yet insolvent. Maybe it was going that way, but I don't think it was there yet. And they came in and took the company and took it over. I'm scared. I don't know what the repercussions here are. So, the fallout from this, the obvious fallout is there's going to be pressure in the regional banks, which we've seen.
Mm-hmm.
But where does it go from there? I don't know. Does this actually stop bank runs? Is the confidence, there that people aren't going to go and take out their money? I mean, some people might be pretty nervous if they were banking at First Republic still here. I'm seeing the stock down 65%. I mean, that's going to make some people nervous, even though, we think that, the government's going to come in and back up the depositors. It's going to make some people nervous. It's making investors very nervous because we know that the government isn't coming out and bearing out shareholders. So shareholders are selling first and ask questions later. And this is across the board. So KRE again now down 7.6%. We've got a financial crisis here happening in the regional banks.
Yeah, Darwin pops in here. When would you go long on the regional banks? Well, number one, they got to stop going down. Okay, and number two, and I did some research, looking around at there's a local Michigan bank here that have up Huntington Bank shares.
Sure.
I mean, you got to know what's in their loan portfolio. I mean, and at this point, even if a bank like Huntington, when I looked at it, has could have a pretty good, conservative loan portfolio, that doesn't negate, people going to the bank and wanting to take their money out. I mean, you can do all the analysis you want, but now it's a situation. I mean, are people lining up at banks right now to to get their money out?
And the point was, Joel, for them to come in on SBNY and obviously back up SIVB was to say, hey, you don't have to go run and get your money. The government's got your back. They were trying to give a vote of confidence to the depositors, but they gave that vote of confidence to the depositors at the expense of the shareholders.
Yep.
And that is why you're seeing, such, so now does it snowball back? Because you've got, these banks, and if you're in a depositor there, you're probably still nervous because there's just the stock prices are falling. So if you're paying attention, you're like, I'd be nervous if I had my money in FRC. I'd be nervous. I mean, I think the government's going to have my back, but I don't know that with certainty. And I see the stock falling. I was like, well, it looks like there's problems here. So there's so many unknowns here. And that's what I'm going to come back to. I said it last week. The reason I was raising cash and the reason I'm trading it obviously from a conservative perspective is there's so many unquantifiable risks at this point in time. I, as a professional trader, am a risk manager. I assess, estimate the risk, and put my trading capital in places where I feel like the risk reward ratio is acceptable or favorable to me. In the regional banks, it's off. Like, I mean, I can't just come in and say, yeah, FRC's at deal at $28 because it could be zero this afternoon with what happened with SBNY. So we don't know. So I'm like, and this is why investors are fleeing. So I'm out. I can't even, you can do some hedging, you can do, but even if you're pair trading these things, how do you know which one's going to, get bailed out, which one's not? I mean, it's hard to even trade these things from a relationship perspective here right now. So all I can say, it was somewhat predictable, or not even somewhat, it was very predictable that the regional banks would be down significantly here today. This rally is gone. This rally in the overall market that we had last night, which I was, tweeting out skeptical on it, but also, Joel, I talked with you. I was like, I don't think it lasts. I think when you just, basically destroy the shareholders just out of the blue like that on a bank, it has repercussions. Again, the depositors are maybe happy about this, and they probably should be, and maybe they needed to do this. Maybe it absolutely needed to happen, but shareholders are selling first and asking questions later here.
I think we need to start asking ourselves, is this going to be more of a bank run or a bank panic? Because I think at this point, it could be more considered even what they call a bank panic, right? What is a bank panic? It's when multiple banks suffer runs at the same time as depositors make a run for the banks at the same time. Do you feel that that's what's going to happen today, Dennis? Everyone's just going to come running for their money?
I don't know. I don't know if the depositors are going to come running. I'm not trying to predict bank runs, and we don't want to spook people and scare people and start problems here. We're not about that on this show. We're just outlining. We're trading.
It's actually a concern. I'm thinking about it, right? I'm thinking about it right now. I'm thinking about maybe taking my money out of Ally.
We all are. I mean, we're all somewhat seeing stuff that we haven't seen since 2008. I mean, I haven't seen bank moves like this since 2008, where they go down 30, 40, 60% in a day. This is very scary stuff here. The one thing I can say is the Fed has got to be looking at this and saying, holy cow, what have we done? What have we done?
So
let's talk about the Fed.
This comes from the Fed. This comes from raising interest rates. I mean, the whole SIVB, they got the bad mortgage book because they raised the rates too fast. I mean, the Fed's got to look at this, and obviously everybody still thinks they're going 25.
No,
I don't even know if the CPI data matters. I don't think if the banks keep falling like this, they're not going to raise rates at all. They're probably getting close to done if they're not done already. So that's good for some companies. I mean, some tech stocks maybe eventually, could rally on this, but there's so many unknowns. As you get banks going down, like we can even see, the repercussions. Roku, over the weekend saying they have $500 million with SIVB. Now, again, Fed coming in and saying, yeah, we're going to guarantee those depositors. So that's good news. But all these companies have monies in banks. I mean, in a lot of these banks, you start to have problems in your banking system, you have problems everywhere. So the Fed needs to fix these problems somehow very quickly before they do continue to spread, because this can be a contagion in a hurry here. And I think you just got to look and really analyze as a trader. You've really got to analyze the risk here. And the risk is very unquantifiable. So I think you got to be very careful with just saying, I'm going to make all this money and I'm buying FRC at $29 here right now. I mean, somebody said that at 81 on Friday, and they're like, oh my gosh, I just lost 65% of my money. So you got to be very cautious with just throwing, and saying, yeah, the government's going to bail these out. I'm going to come in, I'm going to make a lot of money. You might, but the risk here is
the risk reward doesn't
enormous.
justify it. Well, one thing that and we've discussed too is what the raising of rates was definitely something that was needed, right, with the inflation. But the pace that the rates went up,
So fast.
it just went up so
So
fast. So,
fast,
and
Paul.
I'm not saying like like the term Fed pivot is like so exaggerated. What the Fed needs to do now is stabilize rates. I'm not, they got some ammo to take it down. Obviously, they're in the pinch. The CPI data, it's not going to make a big difference, but there has to be some kind of stabilization. And, is that going to be at 4? Is that going to be at, 3.5? There's no way that they can continue this pace to have the volatility in the rates and have the banks keep up. Well, the majority of the banks keep up with it. I mean, it's
If
just we need calm. We need calm.
Yeah, we joked about
Stabilization.
it, and I think that's why they're done. I don't think they're going higher, but we joked about it last week and saying, like emergency rate cut. I mean, if you start seeing banks collapsing all over the place here, not saying that's going to happen. I sure hope it doesn't for the better part of everyone. But if you start seeing that happen, they will put emergency rate cuts out. I'm not joking. There's probably a couple people saying, "What have we done?" And I'm saying, "What has the Fed done?" This is caused by the Fed raising rates too quickly. That is pretty much the cause of this. Yes, it was bad. They didn't cause SIVB to go buy a bunch of, bad mortgages at 1.63%. But
Yeah, it's mismanagement also from the
there's
top, though, right?
mismanagement all over the place here. But the root of all the problems here is still the rates going up too quickly. We kept thinking it was going to hit the consumer. And in the end, maybe it was hitting the banks a little bit, harder because they can't, in the long run, they'd be fine. But, the problem is when you get a bank run, there is no long run. So it's very, very difficult, very, very difficult for me to even wrap my head around what's happening. And I'm going to say here today that nobody knows what's going to happen next. So we keep saying nobody knows anything. This is absolutely the case here. You don't know what's going to happen next. We don't know if there's going to be bank runs. We don't know, but we do know that investors are fleeing regional banks right now. KRE is now down still 7.5%. Wow, it's unbelievable.
It's tough. I mean, it's tough to do. We'd like to do our fundamental analysis here, and we're talking about the situation and technicals here. I mean, you kind of just got to go out the door. I mean, you have
technicals don't matter.
Yeah, there's no chart
Not
here.
right now.
There's no chart here that is going to is going to help you. I mean, I don't know how many people play from the short side. I know we don't have that, that many. Where to cover shorts is one thing. There's obviously going to be rips in these. There's going to be rips, and obviously the rips were sold as they were last night. One thing I thought about, over the weekend, and I like Friday's low. That was just a sitting duck. We took that out at 38.81, and the charts aren't looking pretty. You can say can't talk about tentacles, but there's not much in here to 3,800, and who knows what's beyond that. I think the way the market started off the year in January, just really, that rally on not good earnings, right? Rising inflation. I think that it's just contributing. I mean, I think people had a perception that, okay, the January, so goes January, so goes the market. And this is just a really big curveball.
All that stuff, throw that out the window for now. None of that matters. We're in a completely different environment. What matters is whether we get bank runs or not. That is pretty much the bottom line here. Are investors going to be confident enough, depositors, not investors, depositors, confident enough to leave their money in their banks because they saw that the government has their back in the SIVB situation and the SBNY situation? And that is what the government is hoping they are accomplishing here at the expense of shareholders. They knew this was at the expense of shareholders. So it's a predictable reaction in the KRE. It's a predictable reaction in some of these regional banks. It's a question of now confidence in the banking system. Are you confident to leave your money in that First Republic Bank here right now this morning? Hopefully they've done enough to do that. Hopefully we don't get these bank runs. Hopefully they don't have to buy a whole bunch of banks this week. I'm very worried though that that might not be the case.
I'm wondering what happens in the tech industry with the crypto sector. Of course, Coinbase actually had about 240 million balance in Signature Bank as of Friday. Paxo Global had about 250 million there also. So we need to kind of keep an eye out on how this could affect different tech companies that might have had exposure to these banks. Coin already down in the pre-market. Do you think it could go down even lower off of
this is Coinbase, whatever. I mean, Coinbase is, crypto's a complete sideshow here. Bitcoin's actually trading up on this. I mean, this again, Mitch, if we take
just
it back,
a trade, though. I think it's
stop.
important there.
The whole rational, I don't agree with it because they came in to make you more confident. So, just because Coinbase was invested in Signature Bank, I mean, that's a good thing what they did for, that should be bullish for Coinbase because they're not letting that, go. Yeah, they're not letting it just go down with the flames and people don't know if their deposits are safe. They're saying they are safe. So, I mean, that's actually bullish for Coinbase. But I'm not coming in here and buying Coinbase in an environment where I'm looking at banks falling left, right, and center. It's not, none of this. It's not even about trading today, folks. It's not about, don't approach this market. I don't think you approach this market thinking about how much money I'm going to make. I think you've got to approach this market very cautiously here. I think caution is the key. Don't get murdered on these days. Don't, just jumping in and buying FRC at $81 on Friday thinking this is coming back. I'm going to make all my money. I mean, you've got to be very cautious here. Coinbase is not the kind of stock I want to trade.
That thing's already volatile enough. But let's try and flip the switch. We got to, obviously the negativity, which is more than warranted. But and Dennis, we discussed this last night, and Christopher Marin brings it up. Bank failures could be deflationary, right? I mean, all this money evaporating could have a deflate. It's going to. Unfortunately, this is not the way we wanted to combat inflation and bring in deflation. But I mean, the 2% target that they were talking about, I've always thought that was out the window to get inflation down to. I mean, is it too optimistic to think that in the long run, forcing the Fed's stance here, that this could actually have, if we can have a deflationary effect without ruining the banks, then you could be setting up a pretty bullish scenario. I'm not willing to go that far yet, but
I can. So there's two scenarios. One, if we don't get bank runs, and it's a big if right now, if we don't get any more bank runs, I mean, this actually is all bullish to a certain extent if you can take the bank runs off the table, because this is causing the Fed to pivot much sooner, if not immediately. So, I mean, this is, caused, right now, inflation, they're not even worrying about inflation at this point in time. Yes, they're thinking about it, but it is definitely not the top priority of Fed here right now. There's a whole new can of worms, and they're going to have to pause the fight on inflation to make sure that the banking system is sound. So some tech stocks are applauding that here this morning. We have the tech stocks trading higher here. And you know what? If you got tech stocks with the no debt sitting, I mean, maybe, there is a play here. Those ones, again, though, things are changing so rapidly here. I'm scared to just come in. I'm more comfortable right now, my long-term portfolio with a lot of cash, than coming in saying, let's go buy Meta, because it's up $2 here, and this is good news. If they're going to pivot sooner, all these tech stocks are going to go higher. But we don't know if it moves into bank runs, and all of a sudden, they start bailing out these banks, and then they're underfunded, and then we don't know what we're doing. It opens a whole different can of worms. So there's so many unknowns that spills that theory over that. If you were going to make me buy something, it would be tech stocks today. If you were going to make me buy something, but I don't have to buy anything. I have the luxury of being able to stay in cash. I'm trying to trade a little bit here, but I'm trading very cautiously because I know how this works. And again, you can make a lot of money right now, but you can lose a lot of money too.
More. Yeah. Speaking of tech stocks, I mean, Apple's trading up 25 cents in this scenario. Microsoft trading up $1.91.
Yeah.
Google's in the green.
Pivot coming sooner. I think that's what the market is saying. The pivot could potentially come sooner than we thought.
Why don't we check? ARKK. That's. I mean,
what about your tool, Mitch? Can you bring up your Fed tool?
Yeah, I brought it up a little earlier when you were
Sorry.
speaking there.
Yeah, I was talking, not looking at it. So 50 is pretty much gone.
So 50 is
Oh yeah,
gone. 50
yeah.
is gone. It's
50
off the
is gone
table.
completely.
Yeah, we went from like 80 to like 40, and then now we're at 0.
50's
I love
gone.
I love the way these change so quickly,
Yeah,
right?
so fast,
But now it's looking like the current one is only 12.2%. I think this is what we watched today. Does this change to 80%? That's what I think could happen. These two numbers could flip, where it's not
Yeah.
25 basis
So they're
points,
saying
but then
87% still chance of a
25 basis point.
Yeah, I think that's going to come down. I mean, again, if we turn around, the market starts rallying significantly, and the you know, some of these bank stocks turn around, and we don't have any bank runs, this can all turn around very quickly. But we don't know that, and nobody knows if there's going to be the bank runs, and that's why I just think you got to trade cautiously here. Scary stuff, folks. This is scary stuff. I'm scared too. Like, this is unknown
there you go.
risk.
It's already changing. It's already changing.
Where is it now? Oh, you just refreshed it.
65.
65?
65.
Can we short that?
You mean since this morning?
Yeah, since 7:00, like 7.
Look at that, Joel.
8:07.
I said on
From
Twitter,
8:07
I
to
think it's
8:16.
a 0. I don't think they're going to raise. So
I
already
think they'll
voiced
still
my opinion.
raise.
I don't think they're going to raise.
And I mean, one thing though, you mentioned it. If the bank run thing doesn't happen, like for any reason, this is just what happens.
Maybe this is as bad as it gets.
Yeah, this
is
just
like
saying
capitulation this morning.
Situation is done today.
It's possible.
The banks are not going down as much today, and things start turning around. Does the Fed just go back to inflation?
The Fed is
They're thinking.
do nothing. They can't take rates up.
That's what I'm wondering.
And I mean, they're not. I mean, if they're not going to cover it, they just got to just do nothing and see what happens.
Wait and see.
And I'm going to stick with. I mean, we've had periods of artificially high rates. We had just too long of a period of artificially low rates. There just has to be some kind of stability, and that's funny that or not funny, but yeah, the way that's dropping.
And the
TLT,
And we'll see what. Yeah, I mean, CPI tomorrow. I mean, everything is taking a back seat to.
You ready to laugh?
What?
We got more. No, I went to 73. Now it's going up a little bit.
So what's interesting here, and great
moving
point,
all around.
We watch the TLT very closely on this on this channel. Obviously, we're big fans of the TLT.
Yeah, the bonds.
Try to get a feel. The bonds are going up. The bonds are saying the Fed's done. The bonds are saying right now the Fed is done, and that's why the TLT is ripping higher. This is good news for government bonds. I mean, again, corporates here, if we go into a financial crisis or whatever, it's a little bit scary to go load up in corporate bonds. But if you were looking to get your 5% and lock it in right now, you better be locking it in pretty soon, because these rates, I know Joel's saying they might just stay here, and that might be the case, but they also might go lower. I think you're starting to lean that.
That's interesting.
There's so many unknowns. If you're a Fed, I'm thinking they're either one and done, the 25 and done, or they're just done. And the bonds are applauding this. So there's tale of two markets here now. Equity markets getting hit because the regional banks are all down significantly, and then the bonds. So, but again, tech stocks here are trading higher. There are pockets of strength here. So it's very interesting this morning, I will say.
Yeah, let's look at the bond. Let's look at this bond chart, the 30-year bond chart. Or if you want to look at, I like to look at this because the TLT doesn't trade, around the clock here. But I mean, you saw what happened in October right there. That was the you had the bottom there. We got nowhere on this decline here. We got. We came within a couple ticks or a couple points of it, and like 3 points. And now you're having the strong move here. What the onus is on I mean, who knows how this is a huge move up, but I mean, I'm looking at the 134 level, and I don't know where that equates to on, all the other measurements, but 134 is where this bond, topped out last month, and then that was the same area before, just under 134. So you got some room there. The problem is that the market takes a little time to shake out and bottom after the bonds bottom, and that's what we saw before. I mean, the bonds were going up all of November. Right? Had a little hiccup in December, finally found a base, but I mean, that if you want to look for something encouraging, it's let's hope the bomb. Our crude is absolutely getting
One
lit up like a
one
Christmas
Yeah.
one thing to
tree.
consider
Yep.
too.
Recession.
Mitch, you were asking earlier about fallout and stuff like that. You've got to be somewhat careful with just loading up companies with a lot of debt.
Okay.
I think you're going to be okay, but I don't know for certain, and nobody knows anything for certain. But what happened in the financial crisis with companies that were burdened with a lot of debt really got hammered harder because the unknowns. And you can say, oh, well, interest rates are going to stop going up, so it's been good for companies without debt. But yes, if banks start going down, it adds a whole can of worms. It's nice to be able to sail your own ship here. Like, an Apple that has a pile of money. Yes, they have some debt, but I mean, you start thinking about debt-free companies, those will hold up better than companies that are just loaded with debt. The oil stocks are all loaded with debt. They're financed through all these banks. And there's probably concerns that, oh, this is, they bank over here, they bank over here. The fallout from all that, even, we were talking like with Roku having, a lot of its cash, but not even about cash, just about even having a lot of debt. You just have to be a little bit careful with loading up companies that have a lot of debt here. That's just, and again, everything might change tomorrow. Maybe we're talking something completely different. Maybe no, there is no bank runs. Confidence starts coming back in. We don't know the next thing, but I know in this environment, sometimes companies with a lot of debt can actually get hit harder.
So
Yeah.
is crude more of a recession concern coming in also?
It's a lot of concerns here. So I think it's probably I think it's honestly a concern. Wow. To try to derive how crude is going to be impacted by regional banks falling left, right, and center is really, really tough.
Full
I mean,
disclosure, I went short Valero on Friday because I feel like the XLE is really starting to break.
Yeah, I think you just have capital fleeing a lot of different stuff here right now. And people are more inclined to take gains than take losses. So people will look at what is still holding up pretty well. What do I have gains in and sell it? And that's a little bit of, could be a victim of that too. And yeah, you can say, oh,
Rotationary
but
gain.
crude's really been killed this year. Or, yeah, but, overall in the last 2 years, it's been the place where there's the most gains. So if you're looking to raise cash, people typically raise it from what they are up in as opposed to what they are down in. So if people are nervous and raising cash, it doesn't surprise me that some of the big winners from last year are seeing some profit taking here this morning.
Easy Mike's mentioning, the crude and the backwardation. This entire time that they've had this rally that's been, and that's the longer term traders have been telling you the prices weren't sustainable when the crude went to whatever. Even the front month contracts are reflecting that, right?
Yeah.
That's one thing. This is a big move in the crude oil. The lowest we've been since topping out over 100. If you're looking for a potential area of support, two lows in the same area, 70.63 and 70.80. That's basis the April contract. So keep an eye on that if you are a crude trader. But this has been the area where supposedly they're supposed to be lining up the to refill the replenish the strategic or preserves. So
Yeah, they want that to go down to 50, man. Then they can
yeah,
load up all
I
they
I
want.
think I think 50 or $60 is not out of the question for crude. I've been saying
Yeah,
that. I mean, that's
you
the
have, Joe. You have.
artificially low, whatever. Don't even talk about negative when it went negative. That was just a one day implosion. That I mean, if you think about $10 and you think about $120, kind of what's in the middle, 55, 60, 65. So crude coming down is good for the inflation picture. The problem is that a lot of the commodities, a lot of the softs are still very strong, and that's not helping. And also wages. I don't know. I don't know.
What about the
Wages are
gold
sticking.
trade? What about the gold trade,
Oh,
man?
and
Oh,
that's defense. You're going to go into the classic defense
The
here right
classic
now.
gold trade.
Classic defense. You got a financial crisis. We're buying gold. I mean, the hard assets, right? So, I mean, and again,
You're seeing it up this morning. That's
yeah,
for
you're
sure.
seeing gold up in the GDX. You're seeing that trade off. This is typical when you start to get into a situation where people are getting concerned about their cash in their bank. People are like, give me gold. So, I mean, it's not surprising that gold would be up here today. Again, all of this is going to change rapidly. The information is
Yeah.
going to change very, very, very rapidly here. So you can't just come and stick to your guns and this is my theory and I'm going to stick to it. You've got to be adjusting for new market information. Somebody just, asked a question in the chat. Are, fundamentals becoming more important than technicals? I would argue they've always been more important than technicals, but right now, absolutely. I mean, you can't be just looking at your stock chart and saying, oh, I like this. I mean, you could have analyzed FRC stock chart all you wanted at 120. Yeah. I mean, nobody had this thing going to $30. That's all based on the fundamentals, nothing on the technicals. Like people are technical analysts say, well, it was breaking down, so I was going to do that. No, I wasn't going to do that. It's all based on potential bank run. So yeah, fundamentals trumping technicals all day here right now.
As we leak lower, it looks like we're leaking right here. Starting to leak a little bit.
We took out Friday's low and not much in there for daily lows, but things happen a lot too when in 9:30 when the liquidity comes in or more liquidity. But right now, preponderance of sellers here in the pre-market. We got Tim in the background here because I want to see what some of the market structure looks like in some of these banks.
You know it. Let's take the charts down. Let's start it up. I know he's ready bright and early. Let's get it started. It's Market Structure Mondays. What's up, Tim?
Hey, happy Monday, guys. Or is it? It might not be.
It might not be the happy Monday.
Maybe just say hello.
Yeah.
Just say hello.
Just to say hello,
Tim. It kind of just feels like the financial crisis. You traded these markets back then. I mean, it obviously isn't spread to everything here, but in these regional banks, I'm looking at FRC down 62% here right now. I'm looking, at Comerica Bank down 19% here this morning. I mean, even the majors getting hit here this morning. Bank of America's trading down almost 5% here. I mean, this feels kind of like back days during 2008 when we were worried about the banking system here. How did this happen so suddenly? And what does the market structure say about all of this now?
Well,
big questions to start.
It reminds me of a line by the character Mike from Ernest Hemingway's book, The Sun Also Rises. And the character, they're sitting in a bar, as is always the case in a Hemingway book. And he says, how does a man go broke? 2 ways, slowly, then suddenly. And it's a fitting line because what causes things to all of a sudden fall apart is the culmination of much of what preceded it. I mean, you ask him, it's an enormous question. All right. First of all, so are we in the middle of a financial crisis? Not yet. The way that this happened is pretty. It's a fairly simple thing. If you're, and of course, so much has been written about this, so I will just put this in very simple terms. If interest rates are depressed for a very long time and banks loan out money, Silicon Valley Bank loans out money. By the way, it's not Silicon, just like it's not Oregon. I grew up in Oregon and I lived for 17 years in California. I've spent a lot of time in Silicon Valley. I've known Megan, I'll leave off her last name, for 15 years, who's the head of investor relations at Silicon Valley Bank. She's a force in our profession. So this is a personal matter. This is a sudden destruction of somebody's career job. She'll be fine, but it's a dramatic thing. But if you're lending out money at 3%, and you need to pay 5% to keep your deposits because that's where interest rates have gone, you're upside down financially. And the moment that confidence breaks down, you're in trouble. And that's a 40-year-old bank. It was started in 1983. I've been aware of Silicon Valley Bank my entire adult life. It was one of the first things that I recognized as a core component to the financial ecosystem of Silicon Valley. So it's a reminder that things are tenuous and failure is a part of the natural order. And my bigger concern here is that we don't fall all over ourselves to prevent it. You know, we've got. I feel bad for folks.
Yeah, I do
Just
too.
keep in mind that these are the richest folks on the planet who are providing the money behind Silicon Valley Bank and its depositors. I don't want anybody to fail, but I think we have to be very careful about making everything a government backstop, because if it is, then we don't have any failure at all. And failure is necessary. If you don't have failure if you don't thin the herd, the whole herd expires. And we're walking a rail here in how we approach these things.
Safe to say, Tim, that maybe we are setting a very dangerous precedent here.
100%.
Possibly.
Yeah.
Quite possibly. The government cannot prevent failure. It can only absorb it. And there's a great way to see this. And everybody can do this. You can go look at the Federal Reserve's excess reserves in 2007. They were $7 billion. That is the money that was parked at the Federal Reserve that banks didn't have other things to do with. You have to keep a certain amount of reserves. The banking system in the United States is very, very heavily regulated, stipulating that you're in Canada, Dennis. The U.S. banking system is heavily regulated. Silicon Valley Bank had regulators, had oversight. But today, the reserves at the Federal Reserve, the excess monies that banks don't have a better purpose for, are still $3 trillion. And then there's an additional $2.6 trillion that the Fed has out in what are called reverse repurchase agreements. So we are awash in money. That is the principal problem. The problem here that has created the collapse of Silicon Valley Bank goes all the way back to incorrectly valuing money. When you turn money into a commodity, people get very comfortable. They are unaware that they should bear some responsibility for the risks in the system. Money floods everywhere. We get confused about scarcity and choice because there's no scarcity. And then something fails and we think we have to save it. And what will ultimately be at risk if we're not careful here is the United States balance sheet. And we should be very aware that the United States balance sheet cannot absorb everybody's failure. We're not talking about market structure here, I realize. But by the way, I had many conversations with the head of IR at Silicon Valley Bank about market structure and how the market works.
All right, let's start taking a look at, was the writing on the wall before this happened, Tim, right? I mean, this is another brick in that wall, but let's talk a little bit. Was the writing on the wall before this happened?
Well, and look, can anybody say rightly, could anything have prevented this risk? I've still got exposure to the market. It's my, I've got positions that are down because I certainly did not see this coming. But the data did give us clues. They were there. I looked at them. I did not appreciate them. I'll show you two things. And it is the nice thing about being aware of market structure, folks, because even though I overlooked this, the data didn't. It was there to be seen particularly in the financial sector. And I'll show you what I mean. And so you can always look at this. So market structure, by the way, is really taking the rules. The stock market is also heavily regulated. It's taking the rules and using those to understand supply and demand. And so green, demand, gray, supply. And you could look at it everywhere. So here's I'll show you two things, and then we can look at some of these stocks. But this is what the financials were doing. And I just went right past it. I went past the fact that demand was barely clinging to 5 in the financials, and supply was exploding. It was way beyond 50%. So more than 50% of the trading volume in the hundreds, we have 506. It's probably pretty close to the GICS sector data from the S&P Global, because we licensed that data. That group was over 50% short heading into this. So there were already a lot of bets that were short on financials, and I just kind of whizzed right by that. I didn't give it good. I didn't give it the due that it deserved. And then my short beta portfolio, which is looking for things with rapidly deteriorating supply and rapidly deteriorating demand and rising supply, look what was leading. Financials. And again, I just didn't really see that because I don't short stocks. I short the market. I use SH routinely. That doesn't move a whole lot, but it doesn't have to. You can get in and out of it in great size. It's an ETF. It's a derivative. ETFs are derivatives, but it's very easy to get in and out of it. No, they're pooled funds. No, they're not. They're not. They're a substitute. The assets will be owned by whoever sponsored the ETF, not by you. You will own an ETF, which is a substitute, but it's a very liquid vehicle. There were two signs right there that were telling us there were trouble. There were troubles in the financials group. And ironically, on Thursday morning, I actually tweeted before the market opened, is SIVB or are SIVB and Credit Suisse, which is down 65% over the last year, it's trading at 260. Are they canaries in the coal mine? I don't know if that's true, but clearly one of them's gone. Now we've lost two banks. Signature Bank's gone too. But was there? It can happen so fast. It is so blinding speed, right? So we could look at the fact that the tech sector was experiencing layoffs where the rest of the market wasn't. Almost every day there was a tech company announcing layoffs.
Mm-hmm. Now what's next, right? I think that's what everyone wants to know. What's Market Structure Edge telling us what's next or what could possibly come, especially with, I think, option expiration coming?
Quad Witch, Tim. Yeah, I mean, a period where you get extended volatility on top of it. We had to roll over last week in the contracts, but possible surge for stocks with this expiration looming. It sure doesn't feel that way right now.
It sure does not feel that way. One thing I want to point out about Silicon Valley Bank, because was there a sign that it was going to fail? Guess where it occurred? There was a sign. And it occurred at February options expirations. How could you tell? Look at the big spike in short volume, the supply side. It jumped all the way to 62% of the trading volume, and demand fell off the cliff. This is where the people who knew the most bet short. And they were right. A lot of folks covered by the beginning of March, their short volume was back down to 46%. But that's where the bets were. Now, as to what's coming, the first thing to look at is broad market sentiment. What is the broad market doing? And there is good news and bad news. The good news is demand had actually bottomed and is rising. Now it's rising weekly. And supply had come down dramatically. The bad news is supply market-wide in the S&P 500, which rose on Friday, is over 50% of the trading volume. So over 50% of the volume in the entire S&P 500, which is, call it 85% of market cap, is short, borrowed, manufactured. There's a lot of that is trading exemptions by market makers, but those are challenging conditions. On Thursday, was it Thursday? It was Friday. On Friday, believe it or not, the momentum portfolio, which is math looking for sharply diverging supply and demand, jumped up to 17 components, and the market fell apart. Now, the head of the open today, it's back down to 8. Does that signal a 1 or 2 day surge before we have more trouble? I think so. I don't know what's going to come, Mitch. I certainly don't like the high level of short supply or short volume supply in the market. Weak tops precede drops. If demand can't get back to 5 and it's 4.6, 5 is the bare minimum for markets to rise. Over the last decade, the market has averaged about 5.5, and that means there's consistently been more demand than supply. Well, we're clinging to that, so it won't surprise me. It won't surprise me if we have 1 or 2 good days in here into options expirations, because there'll be an opportunity. There's an opportunity to buy low and sell high, very short term into expirations. We'll see. After that, we're going to have to assess. By the way, this options expirations period is split into 2 weeks. It usually goes Wednesday, VIX expirations, Thursday, index options expirations, Friday, quad or triple witching, and indexes rebalance too. This is big quarterly S&P 500 index rebalance. Volatility really wrecks those things. And this time it's Thursday, Friday. Then we have new options trading a week from today. Banks will square the books on Tuesday, and Wednesday, right when the Fed announces its policies, is it going to continue to hike rates? VIX options, volatility as an asset class expires. I think this could be a really potentially tumultuous period.
So what do you gonna look at? What's gonna be on your radar today, Tim? I mean, obviously I haven't been updating the S&Ps because it hasn't
Just
been
keep
pretty
falling.
here. Yeah, we just took out the low for the year, folks. Our January 3rd low was 38.49 and a quarter, and we eclipsed that by a good Tim handle. So Tim, how do you approach? What do you got up on your screen? What are you going for?
Yeah, well, in combat, people smoke cigarettes. So I would look for.
So we're gonna go to the store and get a pack of cigs. What do you smoke?
Find your
Philip
smokes.
Morris.
You look at PM or BTI.
Marlboro. You look like a Marlboro man, Tim. Tim, you look like a Marlboro man.
You know what
to
they
me.
call those? Cowboy killers.
Cowboy
man.
killers.
Cowboy killer is nice.
There was a brief period during my wayward youth when I smoked a few Marlboro Reds, but that was a long
Yeah,
time
those
ago.
are those.
man.
That's the cowboy killer right there.
Oh boy, make your
That's
head
a long,
spin,
long
man.
time ago. So we low volatility. You would go to low volatility, and I put a couple of those here in the Benzinga March 13th category or portfolio. Notice that demand's rising, supply is falling. Those are the conditions you want. And by the way, you could probably just go buy a Staples ETF and do all right. If you look at this low volatility portfolio, it is almost wholly comprised of consumer staples. All consumer staples. There's one tech in here, but it's not great. That is actually MasterCard, which is shifting, by the way. A bunch of these things treated as tech. Visa, MasterCard, I think SoFi, a bunch of that stuff right in the middle of this. They're coming out of tech and shifting to financials. Can you imagine? I mean, it's really unfortunate, but S&P has made some changes to the configuration of tech and financials, and what a terrible time for it. But clearly, consumer staples are the way to go. You want stuff basically that is top to bottom at 5 and has less than 50% short volume. That stuff is where the money will go for shelter. And I would look at BTI. There's one. We'll look at the market structure for it. Believe it or not, the best one, although I don't love to have low volatility stocks that are up here at 9, is Kroger. Kroger's in this deal to buy Albertsons, which also owns Safeway, and it's actually very appealing. If you look at this market structure, rising demand, falling supply, see this? If anything moves today, it's probably Kroger. It's probably a pretty good stock to be in. I would again say BTI, British Tobacco. The structure is a little bit better in this than in Philip Morris. Look at that, very solid. Don't trade price. Price is capricious. Trade supply and demand. Those are not capricious. They're predictive. And so demand is very steady, and supply fell, particularly the last 2-3 days. And that tells us this is now part of low volatility portfolios that people are going to use to ride out the potential difficulty ahead. So that's a great way to see it to me.
All right, like always, you guys see all these different areas. You guys can get on your dashboard right now. Just go to Market Structure Edge, check it out. Get your free trial today. Like always, this is available to you guys, and you guys can get a 1-month free trial. So definitely check that out. At least give it a whirl. See what you guys think. And of course, if you guys do go ahead and get that trial, reach out to Tim. You guys need a little help on learning, and there's different videos on there that you guys can learn how to master Market Structure Edge also.
Come join we fill every chair. every week at the Thursday, 2:30 p.m. Eastern Time live demo. I host it myself, and we just answer a bunch of questions and talk about using the data. So grab a spot. Just hit the request demo button at marketstructureedge.com. Sign up for the one on the 16th, and I'll see you there.
There you go. We'll see you guys on there. Market Structure Edge. We'll have you back on, Tim. Have a good one.
Good.
All right, let's wrap up there. It's 8:55. We only got 5 minutes here till 9 a.m. Boys, the wrap up. How
only
are you
thing that
approaching
matters,
the day? What's the focus?
All that matters is the banks. All of this other news, like, I mean, Pfizer taking over. We didn't even mention his merger Monday.
Yeah.
Pfizer, which I still own shares of, obviously, taking over CGen here this morning. Cash takeout price. What was the cash takeout price? And this was much higher here, Mitch. $200 is trading at. The cash takeout is much higher than this.
$229 a share.
So it's literally getting on a cash deal, Joel. It's getting a 29-point discount here because they're just like worried about everything. Holy, 29-point discount here on this. That's a big discount. I don't know what, like, again, we're in different times here right now, so people aren't employing capital for a 29-point upside. They're like, well, 200-point downside. But I mean, that's not the case. Wow, it's just a very difficult environment to be bullish in here right now. And I mean, the bears took over, and again, the bulls can take over again here soon. It's all information coming to us. So how bad does it get today? How bad does the KRE get today? I don't care if you don't even trade banks. Keep the KRE on your screen. It is what you got to be watching here. It is going to be the driver of the bus here today, the regional banks. FRC is a driver of the bus. It's going to have halts and halts and halts because they don't halt them pre-market. They only halt them during the regular session, which limit up, limit down is so silly because it's been trading smoothly kind of all morning here. And then they're going to immediately halt it. There's going to be other ones that immediately halt. I mean, you can just go across the board, and there's going to be a pile of these banks here today, which we've talked about on the show already. A lot of these regional banks are going to be all over the place today. Tough. It's scary times a little bit.
Yeah, it's boy, we thought that covering the COVID period was a little bit difficult, right? But that
was scary too.
Yeah.
We had stocks moving those days too, but we're back to these.
That was pretty
times.
scary. Yeah.
The VIX is 30, folks. The VIX is 30.
That tells you a lot, right?
Week. Sneaky. Very. Everything happened very, very, very fast.
Yeah, we do. I see people noting here that there's going to be a speech by Biden at 9 o'clock.
9 o'clock. But I you know how it is. He comes 30 minutes late, so he'll wait for the market to open. Get ready for the market to open. Biden to be on, right? Right at the. He's usually about like 15 to 30 minutes late. Like that's one thing I've already caught that on almost every speech. It's almost like it's planned. But just to mention that, we'll definitely be watching here what happens out the gates. You guys can keep up with all the action, of course. Keep up with Joel Elconin on pre-market prep. And definitely catch the closing print. I will let you guys know I might have to step out for start swing trading today. So I want you guys definitely all over there. Catch the closing print today. I'm sure Joel will have a good guess.
Yeah, we're gonna have Christian Fromhertz on today.
What?
He's always calm, cool, and collected. So I don't know. I mean, do we squash ticker time today? I see we got a few minutes left.
2 minutes, a minute left. We can do like one or two names.
Yeah. Let's just, talk to Chuck. I don't know what, it did get a nice bounce off its pre-market low. I think just kind of in general, look for where these stock, if you have a short or you're thinking of attempting a long, look where things trade in relation to the pre-market. Also, I was looking at some stocks, and there were a few stocks that I was looking at over the weekend that didn't make a lower low on Friday, that exhibited some strength. So I think that would be another thing for Schwab today here. I'm sure a lot of people would love to see that mark at 58.70. The bottom of yesterday's range and a gap fill is 57.31. And someone really stepped up here under $50. So kind of get the feeling the pre-market lows in on this one. Dennis or Mitch, you want to take a stab at that one? Or Dennis, you want to talk any technicals at all?
No, it doesn't matter at all. It's all just a matter of things being more bank runs. I mean, again, Schwab, you would think would be a more stable company than what is showing here.
Down 26
I mean, we haven't seen any
27% in
falls
4
like this
days.
in Goldman or Morgan or any of the big guns, but Schwab's obviously got some other exposure from somewhere I haven't researched enough. It's hard to
Yeah,
research,
I know.
even the big guns. So obviously there's more exposure here too, somewhere,
Yeah.
or wouldn't be falling 20 points in, 3 days. But again, there's just high risk stock right now. So much it's high risk right now.
All right, and I'm gonna close out. I'm gonna try and close out on a positive note here on definitely a negative morning, but this JP Morgan chart. I think that's what I'm going to be keeping an eye on. Not really. I mean, it's down to $1.15 today. It's not too far off its recent high, the move. So, Bank of America is a little bit different situation. I know they have a little bit more of a risky loan portfolio, but I'm thinking of opening a JP Morgan account today. I mean, and I'm sure the phones are ringing off the hook. So it's
That's one
down.
thing to think about is that as you get more and more concerned for the banks, the majors maybe pick up some of this business. It's like, I don't want to bank
Exactly.
in a small little regional anymore. I
Yeah.
want to go to the majors. There's something to think about there, Joel.
Yeah, I'm seriously.
I think when the dust settles, the majors are the ones that actually do win
And,
here.
Yeah,
could they
well,
scoop
Dennis, I
up
know
some
I told you
names?
not to buy it at $29.99 because you would get it at $28.99. So
Yeah.
I'm gonna hold off on my my call here, but just keep Friday's low is way down on 127.82. So keep an eye on those levels. See if it can go green at 133.65. I'll let the president speak. I'll let you guys finish up.
Sure.
We're gonna figure this out
I'm done
someday.
too.
Oh, I'm ready.
I'm just gonna
Someday.
say caution. I gotta go trade, get out of my stocks, and then just like relax for a little bit here because I had a lot of overnight positions and they're all over the place. I feel like I'm hedged, but there's some wild trades here, man.
Whoa,
So-
Biden's on time. That's a scary thing.
Okay, I'm
That's
gonna
a
listen
scary
to
thing.
Biden.
Shut up.
Let's see what
That's
he
a
has
scary
to say.
thing.
We'll see.
All right, team. I'm
See
going
ya,
to be
Mitch.
focusing on some position. I'll let Dennis get out of here, team. I'll let you guys know a little bit about what I've been having on. I still got some Morgan Stanley. So full disclosure, still short Morgan Stanley from 95.34. Going to keep watching the last little bit of shares that I got. I've already taken profits from here on out. It's break even on the rest. Looking for it if we could continue going up about 6.75% on that name. Short Valero, I mentioned that earlier. So we'll look to see what happens there with Valero and these energy names. I'm starting to see them crack. I think energy could start coming back down if crude goes to, especially WTI. That's what I'm focusing on. If that can crack into below the 70s, that's going to be a sign of concerns for some of these oil names. And I think you start to see some of this oil trade turn around and come to the downside. XOM. Another one, right? Just cracked that 110 area, going down to that 104. Looks like it's really falling off the wagon there. You could see it in Chevron, right? Chevron daily. That's a bearish candle. That's a nice crack there. Oxy, the same thing. I don't know if Warren saves it this time. Warren might let it drop this time, I feel like, because it is coming back down to the 57s. I think it could come back down there closer towards 50, 45 before maybe Warren steps in here. Seeing the oil trade turn around, so I'm going to be looking to hammer that one a little bit. And I also got another swing on. I'm swing on win to the short side. We'll see what happens on that one. And we'll see if I'm able to take some profits today. You guys come over to live trading action. Come check out some of the swing trades. Come check out some of the day trading action. We got a lot for you right here on Benzinga, of course. You don't got to go anywhere. Hit that thumbs up. Come over to live trading now and check out what Lord Ryan and I are going to get into. Like always, you guys can keep up with everything we do. And we will be starting a new book this Sunday. Yes, I said it, guys. For the new book, I want you guys to join in. We're going to be getting into Japanese candlestick charting techniques. So if you guys want to learn a little bit more about technicals, and yeah, I know technicals aren't everything, but I'll tell you one thing. They're definitely a tool to have in my tool belt. I use it. I like to combine variables. But if you want to learn a little bit more about candlesticks, different techniques on how to use that, come over to our book club. That's going to be starting back up on Sunday. So I want you guys to get over there. I'm going to give you guys the link to join the book club. We get members every single week, and it's the only exclusive club here that you only get access if you're part of the club. All right, we'll see you guys over now to live trading. Smash the like if you guys enjoyed today's show and enjoy all the hard work that Dennis, Dick, and Joel Elconin do for us here on Pre-Market Prep. And I feel that we've truly been on top of this banking situation. So if you guys could just do a favor for just that, hit the like. Let's see if we at least get 1,000 likes today. I know we're nowhere near that right now, but you guys been watching the show. How on top has Pre-Market Prep been all over this banking situation? I hope you guys smash that like and enjoy it. Now to get you over to some trading action.